Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. The Fed's master plan is revealed. We're going to talk about exactly what that is and what that means for this economy. So let's dive in.
Trade Genius.
Hey guys, I'm gonna tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
All right, Bob. So, we talked about real estate and what to look for when that will trigger the next downturn in housing. And the Fed's given us a similar roadmap, haven't they?
Yeah, I mean, they have. And look, set the stock market aside for a second. Main Street is sucking wind. And so there's a phrase out there called pushing on a string. So, no matter how much money they've thrown at us from the pandemic response, is that people have spent that and now are unable or unwilling to lend or not allowed to borrow. And so, look at this chart, cumulative C&I loan growth. This is the bread and butter of banks, not housing, loans for industry, and it's collapsing, Phil.
Yeah.
Utterly collapsing. And look at the median. And so when you run a Ponzi type of economic system like we do, it's called debt-based, the only way that you survive is you have to keep increasing the debt. And then if you can't, you get a reset. And the reset is in progress. We no longer have to say in our titles, something is coming. It's already here. And, I'm already starting to see it here in California. People are just tapping out. And now people are leaving the state here because they have to, not because they just want to leave for better taxes. They just can't afford to live here because they're not making the money anymore.
Yeah, and I think that's, I think this is part of what the Fed wants to do to try to get the, so you have the Fed trying to fight inflation, right? And they want to slow the economy down, and the market's trying to call their bluff. But, I think this ties hand in hand with what we're seeing with things like the other delinquency rates that are going. So this credit contraction, this is how it's really a thing, in my opinion, is when you start looking at stuff like the credit card delinquency rates. And again, like, how many graphs do we have to see where we're seeing the metrics that are rivaling or exceeding what we saw in 2008 prior to the big rollover in the markets there?
Yeah, I mean, look, and this is before people have to start paying their student loans back again, Phil. Mm-hmm. So you're going to see August and September, you're going to see even more of a slowdown in terms of spending because people literally have run out. Because, these student loans were slush funds. You know that, right? So, yeah, they gave you money well above and beyond what you need for tuition. They gave you money to live on, and people lived on it, And so now some are being forced. I know there's some people getting delays, but they're out of options to spend, which is pretty freaking scary. And so, it's really weird too. So the government is spending money trying to offset the collapse in the economy. So we have this situation where I think this is really the ultimate goal of the elites. Their master plan is to have the government be the only person with the ability to borrow money. Mm-hmm. And when you have that ability, you create slush funds where then you can then direct behavior in the corporate world by tax credits and by low-cost loans, and you got to be on the right side of the government's thinking to be able to get this money, and then they can direct from a command economy. So capitalism is dead in this environment, Phil, and so now we're in in an environment where I don't want to call it communism or Marxism. It's I think it's even more insidious than that. I guess this is true fascism, right? Corporations and government in total cahoots. Government has the money. They provide the low-cost loans to their favorites. And then you have an economy that then really gets volatile because government's typically pick wrong, and they pick the worst outcomes, because they're really designed for political purposes, not designed for economic activity. So I just, this is going to be nasty. Going into the election year, they're going to create a whole millions of very unhappy people. The Democrats hope the unhappy people will be pissed off at the Republicans. The Republicans hope the people are going to be pissed off at the Democrats. So, but in the meantime, I would expect a lot of volatility and a lot of selling in the stock market.
Yeah, and for those that think it can't happen going into election year because they always prop the markets up into an election year. I mean, look at what happened when Bush Jr., right, in his election, and yeah, I mean those when those elections were coming up, the market fell apart.
And also, that's the reason why Gore didn't get in. The NASDAQ blew up going into his election.
Yeah.
So, yeah. This is the year before the election year, where the people typically have the best of the 4 years heading into a election of a first term. So,
right. And people forget, like short-term memory. You have some of your most volatile, worst markets sometimes in that election year and right into the election actually too. So don't forget that. The other thing too, Bob, is kind of along with the credit card delinquency rates is also what's happening with auto loans too. Same picture. And again, another situation where all these levels are rivaling what we saw last time we were in trouble, which was the great financial crisis, briefly in COVID, but that kind of reset. So I think with yield curve and everything like that, you have to look at the great financial crisis and the dot-com bust as kind of like the two most recent relative periods that we can compare to. But hard to argue this. Now, if you're looking to buy a car, absolutely, I think you just wait a little while longer. I think used car prices are going to come crashing down as the repos. I think I read something like 10 to 20,000 repos per day in this country right now, Bob. It's really, really high.
Yeah, and in fact, I'm in the car market, but I'm in no rush. So I'm going to evaluate September, October when we do the transition of the model years, and to see what's out there. Look, I'm already surprised how good some of the pricing is for the 2021 models. So just people buy a 3-year-old car, hopefully that has less than 50,000 miles on it, and get the extended warranties. I drive 10,000 miles a year, so I'd be happy with a car in that range. And I think I'm going to get a slew, especially what happened. People bought a lot of luxury brands, Phil, with the Fed money, and a lot of these guys are coming onto the market again, and a lot of these are coming off leases. So I think we're going to get some really, really, really good deals.
Yeah, and the luxury market's probably, I saw some comments about covering that, and we probably should, because that is a market that is very telling, and we can kind of look at that historically as it correlates to the other markets. But we have all this data. We know credit looks like it's going to shrink. So how does that look historically, Bob? And I think that this next chart really tells the tale. Well, bank lending will shrink significantly over the coming quarters. So basically what we have here is the green line is C&I, construction and industrial, right, Bob? C&I loan growth.
Yep.
And that green line is now. And then you have the Fed SLOOS, which is a 1-year projection line. Okay. And that 1-year projection line is deadly accurate. As you can see, reality ends up catching up to it, or catching down to it in this case. And so you can see where that's projecting out well into the end of the year, into early January 2024. And you can see those gray bars in the background, those are all recessions. So by definition, we should already be in a recession. Bob and I have told you that we think we've already entered one. It's just a matter of confirmation. We do have some GDP numbers that will be coming up, then we'll see if that starts to confirm or not. But I think that Bob, we were talking before the podcast, the way this market is, where it's trading at, it's acting like, because everything runs on cheap credit, and we've had 0% interest rate for a long time, or very close to that, and this market is acting like that's where we're at. So either it's right and we're going to go back there, but if we do, then that guarantees a recession, because the only time that Fed really cuts in this situation is when we go into a full-fledged recession, or this market is just completely disconnected and eventually is going to catch down, and we're like fair value says, we're about 700-800 points over fair value.
Yeah, I think they're going to squeeze with higher rates. I think they made a decision they're okay with collapsing loans. And look, And also, people do not discount this commercial real estate implosion. I mean, you're talking one of Cerebus Capital, one of the smartest people trading, with hedge fund out there. They just gave back 415, well, not gave back yet, but for 2 months, they've not made a $415 million loan payment on 30 Courtyard by Marriott's. Okay. So, I mean, on this weekend, we talked about housing a little bit. People say, well, there's going to be housing, because we have renters. Well, guess where they're going to be sticking these people? They're going to be converting properties that are already up. These towers are going to be converted. There's going to be supply coming online that people think that there's going to be a supply shortage to suck up this stuff. And who's going to give their house away for free, right? Just because people are poor. When I grew up, there was multi-generational housing under one roof. We're going back to multi-generational housing under one roof. Okay. And so, to people to think that this is a temporary phenomenon, I think they're going to, as I put it to you in the thing, that they're going to get their heads handed to them. They have no idea. People are going to get barbecued here, and you're not going to be able to redo the loan. These things are just going to be, people are going to throw away the keys, because what else is happening? The tax bases start to suffer. The municipalities start raising the tax rates up. So, you're not going to be able to escape it. And it's just going to become really, really, really bad. This is how it was in 2007, 2008, where housing started to wiggle and everything was good. Everything was good. Everything was good. And then August came along and we plunged. And so I'm not saying this August we plunged. I'm just saying that people have this myopic view of the future, because when things trend, people feel that they trend forever, and people use truisms that aren't really true. It's just the things that they've heard in the past. Real estate never goes down. Well, guess what? Real estate has gone down twice in the last 20 years. Okay, it can go down again because the baby boomers are rolling off. So World War II is over. The great migration's over, and all this stuff is going to just look at what Phil and I are talking about. Housing today. I mean, housing this weekend. Autos today. Loans tomorrow. Companies are going to retrench because they have to. And also this in this commercial real estate environment, Phil, people are starting to sell their liquid stuff just to try to keep from going bankrupt themselves. So if you have a portfolio and you have something that's performing, that's being sold now. Okay. And just to people hoping they can ride this thing out. Because I think this is the reason why the stock market hasn't gone down yet. People think Powell's going to blink, and I think he's not. And that's my thesis. I'm trading long, but man, I have 1 foot out the door, and I'm selling into money covered calls now. I mean, I'm nervous wreck, except for energy. Look what energy did today, because they were shorting energy so hard to keep inflation down. And guess what's happening, Phil? Short squeeze.
Yeah. So, guys, I think it would be cool if we could get some feedback on, do you think this bank lending shrinkage is right? Do you think this is going to basically tell the tale and send us into a recession, or maybe we already are in one? Love to hear your thoughts on that. Also, are you, what's your thought on autos? Are you looking for one? Are you going to wait, or are you just good and you don't need to buy right now? And also on credit cards, how are you guys doing with your credit cards and things like that? And we did a video a while back. If you are struggling with credit cards, we have some great tips on that. And we can post that link if you guys need that. So let us know your thoughts below. I'd love to hear how you guys feel about this stuff. Other than that, Bob, I think that's it. We'll see you guys tomorrow on the next video. Thanks for watching, guys. Please hit like and subscribe. Also check out our specials at tradegenius.co, and also check out our newsletter. And we'll see you guys on the next one. Take care. Bye-bye.
Bye.
Trade Genius.